Hey everyone, welcome back to Finance Sphere. What if I told you a major liquidity shift is coming? Right now, heading into the second half of 2026, most central banks want to hike interest rates. But behind the scenes, a massive amount of capital is quietly waiting to enter the system. Inflation fears are still lingering. Because of that, the Fed has been hesitant to cut rates. In fact, the market is already pricing in potential hikes by the end of the year. But here is the real question. What if the Trump administration has a secret weapon? Today, we're breaking down the administration's strategy. We'll look at this upcoming liquidity injection, its impending impact on the markets, and how things historically shift right after a second term president's sixth year midterm election. Let's get straight into it. When a re elected president hits their sixth year in office, voters get tired. Fatigue naturally sets in against the current administration and the ruling party. Historically, sixth year midterm elections have been incredibly challenging for the party in power. They usually lose control of both the House and the Senate to the opposition. Look at the polls ahead of this November's midterms. Public sentiment toward the Trump administration reflects this exact trend. It doesn't look good. Strategically, this triggers a predictable response. Between August and October, right before Election Day, the administration is highly likely to roll out aggressive policies. They need to win over voters. And let's be realistic. The single best way to shift public perception is by improving market liquidity. When cash flows into the financial system, major asset prices move higher, portfolios grow, and when people see those green percentage gains, their outlook on the broader economy naturally improves. But how can a country already buried under debt simply generate more liquidity? Well, the Trump administration has been planning this since last year. Back in 2025, they passed the Omnibus Budget and Balancing Act, or OBBA. This bill raised the U.S. debt ceiling. The explicit goal? To pave the way for heavy government fiscal spending. Here is what they did. Instead of dumping Treasury bonds directly onto the market right away, they've legally built up cash in the TGA, Treasury General Account. This is essentially the government's checking account held at the Fed. As of July 2026, that balance has swelled to a staggering $800 billion. Right now, that money is fully loaded. It is ready to be deployed the moment the administration gives the green light. Historically, sixth year performance has actually been pretty solid. Risk assets usually wrap up the year with decent gains, but don't expect a straight line higher. August and September could still get messy. August is typically a heavy month for U.S. Treasury issuance. On top of that, September historically tends to be a seasonally weak month for the markets, right up until the Jewish holidays. Plus, the Treasury has already announced plans to build up even more cash reserves during the third quarter. Expect volatility. Now, you might be wondering, if the administration has this capital ready, why are they sitting on it? Why not spend it right now? It comes down to political timing. A liquidity pump has the maximum psychological impact when market anxiety is at its peak. If the government spends this cash too early in August or September, the momentum wears off. The high is gone by the time voters actually cast their ballots in late October. To get the maximum impact, they need to time the injection right before the votes are locked in. Plus, the financial markets react fast. The moment the government starts spending, net liquidity indicators reflect that change within days. The impact is immediate. In economics, we call this the wealth effect. We feel significantly more secure and are much more willing to spend when the value of our investments increases. A rising portfolio feels much better than a standard salary bump. Support the market in October. Create a psychological illusion of wealth among voters. Then carry that positive momentum straight into the ballot boxes before the excitement fades. This political timing also aligns perfectly with the biggest spending season of the year. It's when Americans naturally open up their wallets. We have Black Friday in November, followed by the holiday shopping rush. They secure the votes and they manufacture strong economic data for the retail sector. So, What happens once the election is over? First off, the market gets a sigh of relief. The political uncertainty is finally gone. If there's one thing markets hate, it's uncertainty. Once that's out of the way, paired with the liquidity already poured into the system, the market is highly likely to experience a relief rally. Historical data suggests that this pattern has occurred repeatedly. Risk assets almost always move higher post midterms. However, after pumping unprecedented amounts of money into the system post COVID, the Fed aggressively hiked rates. They went from near zero to 5.5% starting in 2022 to cool down inflation. Even though they brought rates down to about 3.75% by the end of 2025, the weight remains. Years of accumulated high interest rates are still heavily pressing down on the broader economy. It takes time for the system to break. Usually, it takes about 2 to 3 years for the shock of rate hikes to finally impact the weakest links in the real economy. The Fed hit its peak rate of 5.5% in this cycle back in July 2023, while they eased it down to around 3.75% through 2025. We are still sitting in a fundamentally high interest rate environment. More importantly, a massive wall of debt is scheduled to mature between late 2026 and 2027. This is corporate and commercial real estate, CRE debt, that was taken out during the peak COVID liquidity boom. A huge volume of U.S. commercial real estate and small to mid sized business loans are coming due all at once. Companies sitting on stressed loans won't be able to just extend them, they will be forced to roll over their debt. Think about the math. Rolling over a loan that was locked in at 3% at today's 7% or 8% rates is brutal. Typically, companies try to roll over their debt or reissue bonds early. So, through the spring and summer of 2027, while the liquidity expansion is in full swing, things might look fine on the surface. It will look like these businesses are managing to refinance, even if they have to pay a premium. But don't be fooled. By the time we hit the second half of the year in August and September, zombie companies will hit a wall. Those that simply cannot survive these higher interest costs will likely be forced into default or bankruptcy. Even if these companies start feeling the squeeze as early as Q1 or Q2 of 2027, it takes time to show up. It takes at least 6 months for that pain to ripple through the banking sector and manifest as systemic distress. Throughout the past few years of tightening, the Fed managed to artificially delay the pain. How? By draining cash from its emergency backup pool, the reverse repo facility, RRP. This effectively masked the tightening effects. This reverse repo liquidity, combined with fixed rate debt shields, bought the real economy some time. But time is running out. By the second half of 2027, as vulnerable companies multiply, they won't be able to handle the high interest burden any longer. That being said, don't panic just yet. Rather than obsessing over the risks of 2027 right now, our primary focus should be on the immediate opportunity. We need to capitalize on the liquidity rally lined up between late 2026 and early 2027. Think about the catalysts: an $800 billion war chest ready to be deployed for the midterms, a post-election relief rally, and the elimination of political uncertainty. These are all incredibly powerful drivers that could push risk assets into a strong upward trend. The investors who actually survive and thrive don't treat a macro timeline as an absolute prophecy. They adapt. When a major economic timeline becomes this obvious, governments, central banks, and corporations adjust their playbooks in real time. As investors, our job is simple: stay disciplined, keep a close eye on market shifts, and constantly position ourselves where the probabilities are highest. That wraps it up for today's video. If you found this breakdown helpful, make sure to hit that subscribe button, smash the like button, and turn on notifications so you never miss an update. This has been Finance Sphere. Thanks for watching, and I'll see you in the next one.